Ma'am, market size is very large. Ma'am, market size is very big. $1 billion, $2 billion company. Quirky designs. Quirky designs.
Hi, Pratik.
Hello, ma'am. How are you?
How are you?
Nice to see you.
Sit.
No, ma'am, it's fine. Namaste, investor. My name is Pratik and I want to present to you my clothing brand, Knights Clothing. We are seeking 5 crore rupees for 10% of my company. We make nice casual wear, good designs. Ma'am, see, I have another design over here.
Sit. What
It's
are
very
you doing? People are looking. Sit down. Tell me about your business.
Ma'am, it's very simple. We go to wholesalers, we take and buy them from wholesalers because it's very cheap, the t-shirts. And then we print really quirky designs on them. And that's the business, ma'am.
Wait. I'm a tech VC. Why are you pitching a clothing brand to me?
Ma'am, we have tech, we can order online, so there's tech, and we've grown also exponentially from 30 lakhs to 40 lakhs in revenue in 1 year.
And how are you valuing your business at 50 crores?
Ma'am, we work very hard. We work very hard.
What's your CAC? What's your blended CAC? What's your contribution margin? What's your growth looking like for the next 5 years?
Ma'am, all this I don't know, but I can get back to you. I'll find out this, but we'll work very hard.
Talk to my analyst once you've figured out all of these numbers and we'll talk later, okay? Bye.
Something was definitely wrong here. I mean, the business was fine, the VC was fine, but something was still quite not right. And like him, thousands of entrepreneurs, maybe even more, understand about money by just looking at this. They think if they raise venture capital, their business will do well. And to be honest, no one really talks about how the VC ecosystem works, what are their incentives and motives, and no one really talks about what are the entrepreneur's motives, what should he be focusing on. So this results in a muddled understanding of this entire thing of running your own startup. So we thought, let's de-influence your expectations about building your own company and raising money. We'll talk about the good and the bad because no one else will. Let's begin. So there's nothing wrong with actually raising money from a VC, and there's nothing wrong in VCs existing because a lot of the products and the innovations we see around us and the products we use every single day happened because of risk capital. Risk capital by venture capitalists and private equity. So a lot of traditional businesses can't make 200, 300% growth in a single year consistently, but certain tech startups can. But since banks won't give money to these tech startups because the market's new, the business new, everything's new, the risk is just too high, they need risk capital. And this is where VC funds come. And there are two kinds of businesses VCs will usually invest in. One, an emerging market, a fast-growing market that requires a lot of capital to capture the share of that market. Like right now, it's the AI arms race. The second kind of business is a company that's growing exponentially really fast, is usually in the realm of tech because as revenue grows, cost does not grow for tech, and usually these kinds of companies require VC money. For example, the entire AI market out there is powered by computation, and the computation happens from graphics cards. The graphic card is made by NVIDIA. So NVIDIA requires a lot of money. Now the interesting thing is, NVIDIA doesn't even manufacture these chips. All they do is design the chips. But the cost of designing a chip is really expensive because it needs to design, prototype, test, and this costs a lot of money and it requires VC funding. And for companies like Amazon and Zomato and Swiggy, all these companies are building something that didn't exist before. So when you have a new market and you're trying to capture that market, all you have to focus on is R&D, new things, staffing, etc. And this costs money. It is risky and therefore you need risk capital, therefore you need investors. I've met so many entrepreneurs worth thousands of crores. They're not raising money to increase their own net worth, and the VCs aren't giving them money for fun. It is done as a business decision and there's a reason behind it. But before we talk about the reason of why money should be raised and whether a business is investable or not, let's talk about how a venture capital fund actually works. Once you understand that, you'll be able to understand what an investable business is. So let's see how a VC fund operates. I'm going to oversimplify this a little bit. So the first player we have over here is the investor. It could be a large pension fund, it could be an insurance fund, it could be other kinds of people, could even be an ultra high net worth individual. But these people would invest tens, maybe even hundreds of $millions in a single fund. All of that is invested in, let's say this, the VC fund. The VC fund is owned by a group of managers, which means these guys actually pitch to different LPs or different investors to raise money for themselves. And each VC fund will have their own thesis. Some would say tech is great. Some would say we invest in consumer durables. Some would say we invest in FMCG. Some would say different things. They have their own way of looking at the world. And if these guys agree, then they get the money and they get a commitment. Then we have people like us, the people trying to raise money. And there are lots and lots of entrepreneurs trying to actually do this. Now, it's very simple to see that money was raised here. They have a fund. They will distribute and start investing equity in each of these companies and try to raise some money. Let's suppose this fund has raised $100 million. Just to run the fund, this guy will charge something called a management fees, which is 1 to 2% a year. So they'll take $1 to $2 million a year just to keep the lights on. On top of that, if the fund makes a profit, then this team makes a 20% cut of that profit. Now, there are a bunch of other rules over here like high watermark, etc., which I won't get into. But basically, this guy's job is really tough because after all fees, he still has to give a 15 or 20% return to these guys at the end of, say, 10 years. And that's 15-20% a year. Imagine that compounded over the next 10 years. It's really, really tough. And why it's tough is because lots of startups actually fail. This study talks about 90% of startups never being able to give any return to their investors. This means that this is a highly risky investment, and it's important that one of these guys give a huge return. How will they give a return? By giving huge growth. How will they grow? By being super aggressive. Take a look at this graph. This is the return multiple of the top 100 startups of a VC firm called Y Combinator. If you look at Airbnb, you'll see it's given 6,000x return. And that's really cool. And even the top 5 startups gave a huge return too. What you don't see here is the thousands of companies Y Combinator invested in. These companies are the ones which gave a return. The others probably didn't. This is called the power law. You'll also see that the returns are so skewed that in 2009 you have great returns while all other years are average or below average. So the power law works in terms of time as well, which means these companies need to give much more than 10x, at least some of them. But he doesn't know which. So he will push all of them to get to 10x, 50x, 100x. This means unreasonable growth even if there is no demand. And this comes to the first problem. What if the industry doesn't need it? What if the industry is not growing? What if there is no demand? Then these people will be forced to grow even though that there is no scope for it to happen. Now, I'm not saying all VCs do this, but a lot of VCs do see the world like this because they're forced in this kind of situation. And the second problem is that because it's a 10-year cycle, they have to return the money to the LPs, which means that they can sometimes force an exit or they have to find a buyer to give it to someone else so that they can return the money to someone else. This causes a problem with the founders sometimes. But before you are invested in a VC, all parties know this. It's not like this is a surprise. The investor knows it, that they're expecting a huge growth curve, and the person asking for the money knows it. They've both agreed and they both think that the growth will happen. That's why the investment happens. Now let's talk about the other side, the founder's side. So when we look at founders and we see that they've raised a lot of money very easily, the truth couldn't be further. It's really tough to raise money. I had a friend who was starting a business in a new industry completely, and he literally met 110 investors, which was 110 meetings. Those are 110 pitches, then there are 110 follow-ups, and there were almost 105 rejections, and 4 of them didn't reply, and 1 said, okay. This means it's really tough to raise money. There are 2 things you need to know about raising money. 1, how good is your skill? If you're really good at something no one else has in the country and you're using that skill inside a business, it really helps. Not only that, that business needs to be scalable and growing fast. Second, it all comes down to relationships. If you know these people well, it becomes a little easy. Now, I know a lot of you are thinking, I'll just go and meet people and become friends with them. It does not work like that. Your work speaks for you. Usually, these kinds of people want to meet you if you've done a really good job building something. So instead of going out to network, think about the opposite. You have to do so well that they want to meet you. And then we have the fact that most startups are not investable. Now, what does that mean? Think very carefully when we looked at that example over here. A company needs to have the potential to grow 100x or 200x. Heck, it should have the potential to do 1000x if it's possible. So now if you think about it, let's imagine a clothing company. Can a clothing company do 1000x? Yes, it can. But it has some problems. One problem is, every time it tries to grow, it has to spend more and buy from the wholesale department, spend on ads to acquire the user, distribute it across the country, and there is cost for every time it delivers something. Correct? So that means as revenue goes up, cost will also go up. Now, when they say scalable, they mean that the business grows, but the cost roughly remains the same or grows very, very slowly. And that gap is what creates a huge value for the VC. Point number 2, a higher equity ownership does not mean more control. Now you tell me, if someone owns 55% of the business and you own 45, who makes all the decisions? Everyone will think the guy with 55% makes all the decisions. This is not true. The truth is, all the decisions are usually made by a board, and the board has certain powers. Now, it depends on how these powers are distributed. Let me explain. Even if you own 90% of the company, you are giving away certain rights. The point to know here is this, that the powers reside in what is documented and not the equity ownership. Another example is that Mark Zuckerberg owns less than 50% of Facebook. But in America, there are Class B shares and A shares and different classifications. And based on that, he has voting control of the board. So even though there's a lower percentage of ownership, he still controls most of the decision of the board, and therefore a lot can pass. Another thing we should talk about is founders making money from startups. Now, think about it. We all think if we own a large stake, we'll make more money. There are a few problems over here. One, you may not be able to sell those shares. If your company doesn't do well, no one buys it, it was just paper wealth. The second aspect is that even if you're not a founder, you can still own shares via ESOPs as an employee. And an ESOPs can make a lot of wealth if things align properly. Like Sheryl Sandberg. She joined Facebook way later and she's an employee. And over the last 10 years, she sold $1.6 billion worth of shares. Point number 3, fundraising is a never-ending process. And let me explain this why from a VC's perspective. So when a VC invests in a startup, he wants to grow that money by getting the second round of funding and helping the company do the third round of the funding and helping the company do the fourth round and the fifth round and the sixth round. You get what I'm saying? He wants more rounds of funding so that the valuation increases. Now, why would a company keep raising money? Because it needs the money to grow. What is growth? Growth could be any metric. It could be signups, could be revenue, could be traffic, could be new rides taken every single day in the case of Uber, could be transactions per second for a financial platform, etc., etc. But the founder can pick the metric. Then he needs to pump in money to push that metric up. 10 million, 50 million, 100 million, 200 million. The J curve keeps rising, and because of this rise, you're able to raise new money, and maybe in a series B or C, the initial investors can exit. So fundraising becomes a requirement and it becomes a never-ending process. Imagine if you told your investor, I will raise one round and stop. How will the investor then make money? That's a problem, right? And this may not be good for the founder or the startup because sometimes you just don't need to grow at any cost for no reason, right? In some cases it's needed, but in many cases it's not. I don't know. It's different for each company, but definitely doesn't sound good to me. Point number 4, high amount of money raised does not equal to success. I know right now you're thinking, yaar, paisa hota na, main sab kar leta. But if you look at the example of Quibi, it raised $1.7 billion and in 1 year of operation shut down and failed. You have to remember, for a company to work, it's not just capital. It's the team, it's the right time, it's the product, it's how you keep the team together, it's the culture. It's also whether you're competing properly or not, it's your strategy. It's so many things put together, and only once these planets align does success happen, which is why it's so difficult to run a startup. Point number 5, raising money doesn't make founders rich, and a high valuation doesn't really mean the founders may be making money. You don't know it, actually. Let me read this. This story is about Ariana Huffington, who sold a company for $315 million. That's a lot, right? Huffington Post is pretty popular, people use it, and she sold for $315 million. But she walked away with only $21 million. Think about that for a moment. This basically means that the value of your company has nothing to do with how much the founder makes. It has a lot to do with other things. Also has a lot to do with liquidation preference, which we covered in this de-influencing video you should definitely watch.